Should I incorporate? When I set him up in business, is it best to go through a limited company, incorporate, or have a sole trader? And actually the treatment of partnerships is very similar to the treatment of sole traders. That's what I want to look at in this video, and in particular I want to look at it in relation to the new tax changes over the last few years, the tax increases that we've seen, and just generally how things have moved about. I do regular videos on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press that like button, it helps me and the channel. So should you have a limited company or a sole trade? Well, first of all, we've got to clear up some things which are not financial and not tax. So there's the limited liability issue. So limited liability protects the owners from their creditors if something goes wrong. And you get that with a limited company, but you also get it to some extent with a limited liability partnership. But a sole trader or a normal partnership does not have limited liability, and that's a sort of legal issue, so it's not really any of my business, but it is actually overrides everything, because the last thing you want is for your creditors to take your house away, obviously. I think also it's important to think about the future. So sometimes, although it might be okay to have a sole trade at the moment, you know that you're going to want a limited company in the future because you can see the growth with great confidence. And if that is the case, it's hassle to change, so you might want to set up as you mean to go on. And also there are things like you want to maybe get some credit history in your limited company, which can be handy in the future. And also if you chop and change, it can confuse the heck out of your mortgage people if you want to remortgage your house. So there are practical considerations. And it is just worth saying that a limited company is a little bit more complicated to administer than a sole trade, which is much more simple, and a partnership is somewhere in between. And that simplicity or complication does cost. So that does need to be bear in mind. But overall, so what has happened? Well, the treatment of cars has changed, and the tax rates have increased in limited companies because the corporation tax is going up from 19% to 25%, but it actually only affects businesses that have over £50,000 of profits. And then also dividend tax and national insurance are both going up by 1.25%. So that doesn't really affect the judgment. We just pay more tax, but it matters, I guess. So when you first start, I always think that it's important to look at losses, because sometimes businesses almost inherently make losses. Like, you know, buying a new van can create a loss. So there's sort of like arithmetic losses even if you're developing your business. Losses in a limited company can only go forward against future trading profits, so you can future profits so that in the future you'll pay less tax. Well, that's not as good as in a sole trade or a partnership, where you can take your losses and put them against your maybe earned income, maybe when you're a high rate taxpayer, before you set up your business in the 3 years prior. And that can have a huge impact, because if you're making a substantial loss and you were paying 40% tax previously, there's a whole load of tax that you'll no longer that you'll get a refund for, and that refund can be really useful in those first years of trading. The next thing I want to look at is cars. Now, cars they're really important because it's probably the biggest expense apart from our house we have. And cars are a peculiarity because they are used partly in the business and partly for your own private use. But it is really important in terms of your overall mix. And the treatment between limited companies and sole traders is very different. So for sole traders and partnerships, you can claim your 45 pence per mile for the first 10,000 miles. Or you can take a proportion of the cost of the vehicle and take the proportion that you use it for private use as opposed to business use. So So that's how you do it in a sole trade. And normally for a sort of a normal fossil fuel vehicle, that is the best way. In a limited company, vans can be very useful. Vans can be in either, actually. Vans aren't taxed too much, but in a limited company, a normal car, you can write off the cost of the car in against your expenses, but it's a benefit in kind, and that benefit in kind references the new price. So if you have a second-hand car, you still get the same tax charge, and it's a tax on you personally, and the tax rates are ratcheted up. So for a fossil fuel car, it's rarely worth you. There are always exceptions, but it's rarely worth you having it in the limited company. But if you've got an electric car, the new rules on electric car, and this is a change. So the new rules on electric car are that the benefit in kind is very low, 1 or 2%. Maybe that'll change as we go along. And when I mean electric car, I mean a plug-in electric with a reasonably long range. And for those cars, you can write off the cost of them in your company over a period of time. But here's a big benefit, is that you have this small benefit in kind, so you pay very little tax. And for those cars, it is generally better having them in a limited company. So cars can be important, and it depends which sort of car, and it depends how car-y you are, because people who really like an expensive car, it makes a lot of difference. If you've got a less valuable car, then I guess it makes less difference because it's less important to cost to you personally. The other thing that's really important is retain profits, and this is something you don't necessarily think about when you start your business. Retained profits, so that's the money that you retain in the business to enable you to grow it in the future, or just have a bit of wool on your back so that so if something bad happens, you can deal with it. Now, if you're a sole trader, those retained profits get taxed at your higher rates, because the tax in the sole trade immediately goes onto your personal tax return and is taxed. So it means that you can very easily slip into higher rate tax, and you can't control it because the profit is taxed. There's no separation. Whereas in a limited company, the limited company makes the profit, and then you may choose to take the money out of the company, and only when you choose to take it out does it become personally taxable and therefore liable to higher rate tax. That is important, because if you're building up reserves in a limited company, you just pay 19 or in the future 25% tax in the company, and then you can use the rest to build the business. But in a sole trade, you might be paying 42% tax, even 47% tax, or in the new rates, a little bit higher. But basically almost half the money goes to the revenue. It makes it really hard to build up reserves. So if you're wanting to buy commercial premises, if you're wanting to increase your trade and then increase your debtors ledger, which has to be funded, then it becomes much more difficult. And with those high tax rates, I know that people really don't like it because they're not taking the money out of the company, but yet they're being taxed on it, and it feels very unfair, actually, I think, is why they don't like it. So that, I think, is an important part of the difference between having a limited company and a sole trader or a partnership. There are other differences. The way that capital gains within the business is different. So it can be better to have a sole trade if you're going to have capital gains. Because there can be double taxation issues if you've got a limited company, but again, it only matters in the limited company if you're taking the money out of the company. So I would say with capital gains tax, if you're worried about that and future capital gains, then you might want to just have a conversation, because it is quite nuanced. But I'm raising it here because it can be important to people who sell bits of their business, etc. So those are the main issues that affect people, and the choice of whether you want to go to limited or a sole trade partnership. So what are they? It's a little bit more complicated if you have a limited company. Actually, the overall tax rates are a little bit less in a limited company, but that is compensated for by the fact that you pay more in admin. it's possible to not pay higher rate tax on retained profits, and you can control when you pay yourself more dividends to get into high rate tax. So that control is important in a limited company. And the limited company can be better for electric cars, but on the other hand, general cars are generally better in a sole trade partnership. Sole trade is simpler. It is better for normal sort of fossil fuel cars, and it's better for losses if you're going to have losses, particularly in those first years. So I think if you're not sure, then please give us a call, and we can make sure that we can help and give sort of more bespoke advice, because obviously we can't advise you on a video because we don't know your personal circumstances. But if you want to be kept up to date, then please subscribe to the channel, and if you press that like button, it really helps me and the channel. Thank you.